And now, without any further delay, let's begin today's event. Once again, HSAs, an opportunity for achieving health and wealth. Once again, sponsored by HSA Bank and hosted by Employee Benefit News and Employee Benefit Advisor. I would like to introduce your moderator for today, and that is Lynn Gresham, contributing editor for Employee Benefit News. Lynn, you now have the floor.
Thanks very much, Christina. Good day, everyone. We're pleased to have you with us for this web seminar. HSAs, an opportunity for achieving health and wealth. Health savings accounts are gaining recognition as a valuable tool for retirement savings due to their triple tax advantage and investment opportunities. While most employers view HSAs as part of a successful retirement benefit strategy, studies indicate they are not yet fully leveraged as a long-term savings tool. With us today to talk about how employers, brokers, and financial advisors can increase awareness and adoption of HSAs are two retirement experts, Ryan Tiernan and Kevin Robertson. I'd like to introduce them to you now. Ryan Tiernan is a National Accounts Manager at American Funds, which is part of Capital Group. He has 16 years of industry experience and came to Capital Group in 2016. Prior to joining Capital, Ryan founded Access Point US HSA. He holds several specialty certifications, including Accredited Investment Fiduciary, Certified Investment Management Analyst, Chartered Retirement Planning Counselor, and Chartered Retirement Plan Specialist. Speaking with Ryan is Kevin Robertson, Senior Vice President of HSA Bank. Kevin has over 20 years of experience in banking, insurance, and financial services, covering a spectrum of employee benefits and insurance products and services. In addition to his years of experience managing sales, he has a diverse background in operations as well as legislative and regulatory affairs. Kevin was also a self-employed business owner for 12 years, managing a large insurance operation with more than 25 separate agency locations. He is a board member and compliance committee chairman of the American Bankers Association HSA Council. Welcome to you both. Kevin, I'll now turn the program over to you.
Thank you very much, Lynn. That was a great introduction. You know, our topic of discussion today is one that we've received a lot of questions about, and with the surge of popularity in consumer-directed health care and specifically health savings accounts, you know, many employers and employees have been asking for insights into HSAs beyond just how to pay for health care expenses and essentially receive tips to maximizing the health and wealth using HSAs. So our audience is a mixture of employer plan sponsors and advisors today, and we've tried to create a discussion to present ideas to answer exactly those questions. Now, normally we'd present an agenda for our webinar, but instead we've elected to focus on the objectives that we'd like to achieve. And these objectives really are to first raise awareness of what we're calling the retirement savings gap, especially as it relates to health care. Then we can move on and discuss strategies related to long-term savings for those healthcare expenses in retirement, and finally explore various approaches to creating a positive retirement outcome using HSAs. And by positive retirement outcome, we really are talking about achieving both health and savings. So to kick us off with our first objective in understanding the retirement savings gap for healthcare, I'm very pleased to turn over the presentation to a tremendously knowledgeable expert, Ryan Tiernan. So Ryan?
Thanks, Kevin, and thank you, Lynn, for having us on the call today. As you know, quite a bit going on in the retirement savings and investing world, in particular with the fiduciary regulations. And as such, I've been compelled to read just a brief statement before we get started. But as you both know, I represent American Funds, which receives fees for distribution and servicing of those funds. So just want to let you know that I'm here not to try to provide impartial investment advice or fiduciary advice for that matter. But with that out of the way, from a compliance standpoint, let's go ahead and get started. And what we're going to start off with today is actually a polling question. So this is to you all as consultants or as clients or even employers. How would you all rate your employees or your clients' understanding of the retirement savings shortfall that we're going to discuss today? So said another way, how knowledgeable do you think your clients and employees are around the retirement savings gap that faces so many of us as Americans? So if you'd all just take a minute and go ahead and answer this polling question. All right, so as we move, what we see, and for those of you who might not be in front of a screen, is that it looks like the overwhelming majority of respondents said that their employees or clients are either have an average or below average understanding of this retirement savings shortfall. 37% of folks said their employees' understanding is about average. 47% said they would guess that their employees or clients' understanding is below average. And that's really not so much of a shock as we start to think about, what is facing folks as they move from accumulation and into distribution. How much do they understand, or what level of understanding do they have around what we would call this retirement savings gap? So what is that retirement savings gap? As we look at a 65-year-old couple getting ready to retire today, what we see is that they may need upwards of $404,000 to cover out-of-pocket health care expenses. And if we look forward into the future, that number could balloon as high as over $600,000. Now, I know a lot of us have seen different stats and different figures. Some are higher, some are lower, but I think what we would all agree on is that it is a very expensive proposition. In fact, the World Economic Forum had recently written a white paper called We Will Live to 100, and what they found was that the retirement savings gap, or the shortfall in the U.S., could top over $100 trillion by 2050. So with that, even though, as we see, most folks probably don't have a tremendous understanding of this retirement shortfall, when polled, 45% of workers consider themselves not confident that they would have enough money to retire, and in particular, not just retirement in general, but in particular to cover medical expenses in retirement. And we think that's a huge risk, but also an opportunity for each and every one of us on the phone. As we move to the next slide, we start to discuss and think about, where are we today, and in particular for households age 55 and older, right? So those folks who are nearing that jump from accumulation to distribution. When we look at those households 55 and over, what we see is that unfortunately 29% of them really have no retirement savings. 23% have a defined benefit plan, but no retirement savings above and beyond that. Where we do see some light at the end of the tunnel is that about half, 48%, have some retirement savings. And when we dig a bit deeper into this GAO government report, what we found was that for the folks 55 to 64, on average they had about $104,000, which sounds like a great amount of money, but when we translate that into a monthly annuitized income adjusted for inflation, it's really only about a $310 income per month. For those 65 to 74, it was, as expected, a bit better. On average, they had about $148,000, which translated to roughly $650 on that annuitized monthly basis. So obviously, quite a bit of work to do as far as getting more folks as they approach retirement to set aside and save more for what we will see is a huge cost, and that is the particulars of retirement health care. So as we move on to our next slide, what we're looking at here are healthcare expenses and how they rise as we age. And in this slide, we're looking at not only by age what we're spending or how much we're spending on healthcare, but also by gender. And something interesting happens here. Under 19, you could imagine healthcare expenses are fairly low. But from 19 to 44, women actually spend considerably more on their health care. And then something interesting happens right around 45. That really starts to level off. And then as we move into the bracket of 55 to 64 and then 65 and above, we see men in particular spending quite a bit more on health care. So this is what we see when we look at it from a gender basis over time. But what happens when we look at it as a couple? So this next slide looks at from age 65 in 5-year blocks, how is healthcare expense actually increasing over time? And what we see in this 20-year time period or 20-year increments of 5 is that we see a 175% increase in the total cost of healthcare and retirement from age 65 to age 85. And as we said, more and more a 30-year retirement will become the norm. These are expenses that we will have to save and hopefully invest for and actually surmount as we make, again, that jump from accumulation to distribution. Now, the question comes up often is, well, we see this huge amount of money. What are we actually going to be spending that money on, right? And it's unfortunate because I think a lot of us on the phone would probably agree that many employees, many just average Americans, are under the misconception that when they turn 65 and become Medicare eligible, Medicare pretty much pays for everything. And I think, as probably a lot of you understand on the phone, that's not the case at all. In fact, once you hit 65 and enroll in Medicare, that's really where the fun begins. When we see how we're actually spending our dollars, how those dollars are allocated, we see about 20% of those numbers, or those dollars we just considered, going to total premiums, and about 80% of those dollars going to total out-of-pocket expenses. So what do we mean by total premiums? Well, here we're talking about things like Medicare, right? That's Part B and Part D, or prescription drugs. We also talk about Medigap. And, as we said, we see huge swings in the number of what someone might need. We see it as maybe low as 260, as high as 400,000. Well, the same can be said for things like Medigap. When we look at the 2016 Medicare Supplement Price Index, what we see is that for the same 65-year-old female, depending on where she lives across the country, her Medigap premium could be as low as $120 or over $400 based on her geography. So premiums, although expensive, really only take about 20% of that total income. It's really when you get into the out-of-pocket expenses that we see the most heavy burden. In fact, co-pays, deductibles, those things are the ones that take really the lion's share of a couple's income in retirement, and those are the ones that we really have to be prepared for. From here, unfortunately, what we see is that as we move on, we're looking at a percentage of total expenditure on healthcare costs. And again, under 25, a very small amount of our total income as an expenditure really goes to healthcare. But what we see is as we get older, that number continues to increase. So what we're looking at here is not only when are we spending the majority of money, but what, as a percentage of our total income, is being allocated to healthcare. And unfortunately, that number just doesn't start to come down. Right? As we age, prices go up, and the amount that we have to allocate to healthcare costs continue to rise. So this in and of itself can be a very daunting number or a daunting slide. But as we move on, we start to see that there are some opportunities to help mitigate this ever increasingly expensive burden. And what this slide shows here are a couple of things. This is income and expenditures by age, and this is data that was recently published by the Bureau of Labor Statistics that show as we age, expenditures start off fairly low. They begin to peak in midlife, and then they start to decrease. And that can also be mirrored by income. And what you'll hear more about today is how do we take advantage of this delta, and how do we use things like health savings accounts to help us overcome this huge burden. If you look at the difference or the delta between income and expenditures, this shaded area here, this is really where we're going to spend the most amount of our time or focus on the call today. How do we maximize all of the tools and resources that are available to us? As this income and expenditures line diverges and then converges again, how can we set our employees and our clients up for success, in between these two lines where it matters most? So with that, I'm going to go ahead and turn it back over to Kevin to take us through some of those tools, and obviously HSA in particular. Kevin?
Thanks a lot, Ryan. I really appreciate providing that level set for understanding that retirement savings gap. So now we're going to turn our attention to HSAs and how they can be a powerful tool to help address that retirement savings gap, and really what employers can do to help facilitate that. Before we do that, while most of the audience is probably familiar with HSAs, we really just need to spend a couple of minutes reminding the audience of the mechanics around health savings accounts. The HSA concept really is a combination of an underlying health plan that's paired with a long-term savings account, where the health plan, and it's called a high-deductible health plan, is designed to cover significant healthcare expenditures or catastrophic events. It's paired with a health savings account, which is designed to allow the person to pay for current expenses and also save for their future needs, and doing both of those in a tax-advantaged basis. And this is really unique. HSAs are unique in the financial world because they offer consumers a triple tax advantage. They have contributions that are made tax-free, interest and earnings that are done tax-free, as well as the withdrawals, as long as they're used for qualified medical expenses, are also tax-free. Now, the idea at its core is really asking people to take a bit higher exposure to costs, but providing them the financial incentives and the individual empowerment to become a better healthcare consumer in the process. Now, just to remind ourselves of kind of why this is important today, we really do believe that HSAs have kind of hit the mainstream, if you will. Employees, quite simply, are talking about these. Many of them have HSAs or are considering HSAs. And you can see this in a couple of measures. First of all, if you look at the employer adoption of HSAs, this slide simply demonstrates that popularity. The norm, the majority of employers today in the United States do offer an HSA-based plan, and that percentage increases as the size of the employer goes up, to where the norm, by the time you reach the jumbo employers of more than 5,000 employees or larger, that more than 80% of those employers are offering an HSA-based plan. Now, in addition to looking at the offer rates, it's important to look at the enrollment rates. Now, this graph here, which is essentially from Kaiser Family Foundation studies that's released every single year, shows the enrollment surge that you've seen in high deductible health plans, most of which are paired with a health savings account. The bottom line is that today, HSA-based plans currently make up about 20% of the privately insured population insured in the United States. And that number is obviously increasing dramatically. And again, the reason we point this out is just simply to say that employees are definitely thinking or possibly using HSAs today. Now, I could spend time talking about a long list of positive attributes for an HSA. I really want to focus on some of the most important as it relates to our discussion today, which is really the bottom of this. I could talk about the increased control and the no use it or lose it provisions, but really I think at its core, the most important attributes of an HSA is that it simply maximizes healthcare dollars for not just the current but also the future expenses. And many times, employees and employers and the norm in our country is to think about current needs and not so much about future. Well, that's really what we're going to talk about today, is the future and what we can do to engage for the long term. If I look at the most important attributes that related to retirement at the bottom of this slide, just want to draw attention to a couple of things that are often missed. If you stop and think about what you can pay for out of an HSA as a qualified medical expense, and considering we're talking about retirement, some of the most powerful attributes of an HSA are these. You can pay for your Medicare premiums on a tax-free basis as a qualified medical expense from your health savings account. Now, currently, Medicare Part A does not have a premium, although that more than likely is going to change in the future. But even if we just confined our consideration to Medicare Part B and D, and considering the number of years that somebody could be paying for those, or even decades that somebody could be paying for those premiums, having a source of funds to be able to pay for those on a tax-qualified basis is immensely powerful and will save the average American thousands upon thousands of dollars over their lifetime. Now, in addition to that, if somebody were to build up a pool of resources for their HSA and they were to use those for non-qualified medical expenses in their retirement, and once you're at age 65, there is no penalty for using your HSA dollars for non-qualified medical expenses. However, you do have to pay income tax because, remember, you've never paid income tax on that money. So they essentially become similar to an IRA or a 401k in that matter. However, one of the more important components to remember is there are no required minimum distributions from an HSA plan in retirement. And if you've ever had to help someone in their senior years and the frustration they've seen with trying to manage their finances and take money out of IRA or a similar retirement vehicle that they didn't want to, it's a frustrating component. Well, an HSA is a very powerful tool there. Now, beyond the economics and the economic reasons to have an HSA as a powerful tool for retirement is really to think about the better health outcomes and consumer engagement that can come as an outcome of consumer-directed health care and health savings accounts. This includes lowered health risks, more engaged health improvement, and receiving higher levels of care. And there's plenty of studies that will point to data to back up exactly what we're saying here. Is as you become a more engaged, better healthcare consumer, your choices that you're making are better, not just with your spending your healthcare dollars, but making your healthcare decisions. And the key concept I want to focus on is really the outcome that we're after is trying to shift people from thinking of their health benefits as a near-term to a long-term conversation. Now, we can see evidence of the reality of this in contribution rates by age. This graph just simply illustrates contributions bracketed by age of account holders. And undoubtedly what you can see is that people, as they age, they contribute more to the account. Now, that conventional thought would tell you absolutely, because generally as you get older, your ability to save and also your expenses generally go up. However, I think there are things that employers can do to help engage their employees in understanding their HSA and getting the most out of it by looking at it through a slightly different lens. I like to look at this as what I will call the ownership phases that occur when somebody purchases and elects to utilize a health savings account. Now, this is really all about engaging people to maximize their skills and focus on the right behaviors, but it has to start somewhere. And quite simply, we've found that it takes time to adjust to an HSA, and it takes time to learn how to maximize their results with using an HSA. So employers can help and we think that they can step up as an advocate to engage their employees to start thinking like this through some simple steps. Walking through the ownership phases, the first inkling is to essentially first elect an HSA, to get the accounts open, to start contributing. After they start contributing their own money to the account, maybe they want to build up enough balance to say that they've met their deductible. And then after that, maybe they reach the next phase where they need to focus on covering their out-of-pocket maximum. And eventually they built up enough balance where maybe they feel comfortable enough to start investing their HSA funds. And really, when it's all said and done, it's about achieving enough retirement funds to help with that retirement savings gap. So let's take a look at some of the specific things that employers can do to help with each one of these stages. I mentioned the first stage is account adoption, essentially getting the account open and people start utilizing it. Most important aspect of attributes that an employer can do is really understanding how to engage their employees. We really believe that it starts with an education strategy. In other words, the employer needs to take a few minutes and develop what are they trying to achieve with the outcome for not only themselves as the employer, but also what are they trying to help their employees achieve. Once they've answered those questions, you can back into it and say, well, how are we going to achieve it? And then focus on the mechanics. What are we going to say? What are the communication materials we're going to use? The final component about engaging employees is understanding how to personalize. Whenever possible, trying to help people, as we had pointed out earlier, they don't understand their retirement savings gap, and largely probably the same can be said for their understanding of employee benefits. So any way that we can help them understand why it's important to me, whether it be through plan comparison tools or personalized scenarios, kind of people like me scenarios to help them understand that's really where the employer can help facilitate that engagement. Moving on to the next stage was really about, once a person has an account open, how do we get them contributing not just money to the account, but really get employees engaged in making their own contributions. Now, I cannot stress the importance of this enough. Many data points can back this up, that employer contributions matter. It really doesn't matter what type of employer contribution strategy they're utilizing, whether they're making a flat seed, whether they're making a match, whether they're utilizing wellness incentives or a combination thereof. Quite simply, making those employer contributions is incredibly important to the mindset shift that occurs when employees are asked to participate in a health savings account plan. In addition to that, and this is probably the most important attribute that drives not just participation in the contributions, but increasing average balance, individual contribution, distribution trends, and long-term engagement, is helping to facilitate payroll deduction contributions. In addition to employer contributions and payroll contributions, finally, the most important aspect with regard to education and communication is to try and move your focus away from communicating on an annual election basis, and that's the most common outcome when we're thinking of enrollment periods, is really trying to develop a long-term view and a long-term communication strategy to focus on that long-term view. That's really all about shifting perception through ongoing education. And when you're going to be utilizing ongoing communication, we highly encourage you to use the tools provided to you by your administrator and health plan. And a couple of simple takeaways or tips that would help is, first of all, whenever possible, try and use multimedia. And obviously, you have a broad, diverse spectrum of employee habits, and if some of them like to have print, some of them like to watch videos, some of them like to read emails or tweets, honestly, all of them are important to utilize because repetition matters. Going over those on not just at the time of enrollment, but on an ongoing basis is really important. So we highly encourage you to utilize the tools that are made available to you by your administrator and health plans. Now, the next stages we talked about were saving enough to cover first your deductible and then your out-of-pocket maximum. And if I were to try and map out employee behavior change, these are the stages that we really start to see that transition to a CDH plan become real. You can actually see it in measurement of short and long-term engagements. And to continue to reinforce this with employees, we really should say to employers that we encourage them to refine their wellness integration and those personalization components that we talked about, and recognizing that they have to do that across multiple user experiences, and to think about how the web and mobile experiences interact with all of those, and utilize tools that are provided by your custodian and plans to help achieve those outcomes. And when it comes back to that education and communication, whenever possible, as we talked about, people have certain stages that they go through, depending on whether they're in a certain life stage, if they have school-age children, if they're empty nesters, if they're near retirement. We all have those different life stages that Ryan had spoken about. We need to make sure that we're taking into consideration into our education and communication components exactly those life stages. The final step with account ownership phases was investing, and honestly, my message there is simply don't forget about investing. It's oftentimes employers really focus on getting the accounts open, getting contributions into the accounts, talking to people how to utilize their debit cards or other spending tools to utilize the availability for their HSA, and maybe don't spend a tremendous amount of time investing. But I encourage you to include that into your communication education materials. Again, talk about and engage your employees to understand long-term needs and use the calculators that are so prevalent and available to talk about understanding how much should I be contributing and what am I going to get at the end and what are my needs in the future. So to talk about creating a holistic retirement benefit strategy, I'm going to turn back to Ryan to take it over from here. Ryan?
Great. Thanks, Kevin. So to this point, we've talked about healthcare and the retirement savings gap. Kevin just did a great job of covering adoption and implementation of high deductible health plans, in particular HSAs. In this third section, we're really going to focus on HSAs as a potential retirement strategy. And there are really a few different ways to think about the HSA as it relates to your benefit package. And as we move into this next slide, we've got another polling question. And there is no right or wrong answer to this question. It's how you feel and how you view or how you think your clients view a health savings account. So the question is, does your company regard the HSA as part of the retirement benefit? Yes, no, or unsure? So go ahead, if you wouldn't mind, and take a minute to answer that question. And as you think about it and as you answer, I can tell you from our standpoint, as we talk with various stakeholders, whether it be a benefit broker, an employer, or a financial advisor, or retirement consultant, we hear answers all across the board, and there really is no right answer. But what we're starting to see is a very stark shift in the way, we'll say, the majority of folks are starting to view their HSA. So this polling question is really meant to make sure we're on the right track and let everybody in on kind of what the overarching theme or thinking might be. So we'll give you another second to answer that question. And then we'll move on from there. So, does your company regard the HSA as part of the retirement benefit? Almost 56 or 58% of you said no. You don't view it as part of a retirement benefit. And for those of you who don't have a screen in front of you, 30% of the respondents said yes, we do see it as part of a retirement benefit. Again, about 57 or 58% said no, and another, we'll call it 13%, said unsure. So with that being said, as I promised, I think more and more folks are starting to realize as we uncover some of these attributes that Kevin just talked about, there is a shift beginning to take place as to how folks are viewing their HSA. What you see here on this next slide is that 75% of employers in one study viewed the HSA as part of a successful retirement benefit strategy. So what do we mean by that? Well, the PSCA, or the Plan Sponsor Council of America, recently went out and did a poll with plan sponsors, so those who are in charge of running a corporate 401k or other defined contribution plan, and asked, how do you view health savings accounts and which bucket should it be in? And according to their study, it was 75% of employers, again, are viewing that as part of their retirement package. For those of you who said no, it's not part of our retirement plan, again, you're not alone. In fact, more and more of us are kind of revisiting this question. And just even 2 years ago, getting out and talking with financial advisors and retirement consultants and asking them their thoughts on the HSA, all too often we heard, well, the H is for health, obviously, so that can't be a retirement benefit. But as we've done a tremendous amount of education and teaming up with great partners like HSA Bank, we've started to kind of turn that tide. And by educating more and more folks, they're starting to see that, yes, in fact, HSAs for the right potential population in a given employee base can be a very critical element to a successful retirement plan. So as we move on, some of these numbers are actually substantiated or corroborated by recent studies from our friends at Fidelity. There's another misconception around HSAs that if money's going into the HSA, it's going to go there in lieu of contributions to, say, a 401k or some other defined contribution plan. And what this recent study had showed us was quite the opposite, or quite the contrary. In fact, 88% of people, so HSA participants who started contributing to an HSA account, 88% of them either maintained or increased their 401k contribution after HSA enrollment. So it was a big concern that if people start putting their money in the HSA, will they stop putting it in things like 401k? And this study actually says quite the opposite. In fact, again, 88% did not do that. What the study also showed us was that for folks who have both a 401k and an HSA, they're actually doing a better job of saving. as a percentage of their income than those who have only one, to the tune of 2.4%. So again, savings rates for the employees with both a 401k and an HSA were actually higher, 10.6% in 2016 versus those just saving in a 401k at 8.2%. So again, whether you are a financial advisor, a consultant, or employer, if this idea that less will go into traditional retirement buckets, we're seeing that that's actually not the case. And again, one final thought to that study was that 21% of employees who contributed to both a 401k and an HSA, 21% were increasing between 2014 and 2016. So the number of employees who contributed to both actually went up over a 2-year period. So we're very firm in our belief that both employers and employees are starting to realize the many benefits of the HSA, not in a one or the other capacity, but a 401k in conjunction with HSA, and much to their benefit in the long term. So as we move to this next slide, what are some of the things that we should be thinking about as it relates to investing in an HSA? And this is where at American Funds we're spending a good amount of our time thinking and researching and answering some of these questions around what are some strategies we might want to consider as it relates to HSA investment, whether that's for the short term, for current expenditures, as Kevin had mentioned, or maybe for the longer term, those folks who want to use this HSA for covering healthcare expenses in retirement, which we know obviously from the first section is a pretty big hill to climb. So first off, systematic investment capability. What do we mean by that? What we're saying here is that whichever HSA provider or platform or partner you choose to work with, ask the question around systematic investment capability. For my employees and clients who decide to invest assets or their dollars in the HSA, and they decide to put those to work in the investment markets, how easy is it for them to do that? Is it systematic? Do I have to move or toggle between 2 different platforms and 2 different screens? Is there such a thing as single sign-on, and do I need multiple passwords? What we're seeing is that the easier you can make the user experience for the employee or for the account holder, the more likely they are to take advantage of some of the great investment opportunities that are being made available to them. Number 2 is around investment options or fund selection. And the question we're trying to answer here is really how robust is the investment selection? Are you providing what we would call reasonable choice as it relates to the selection of investments inside of the HSA? As we look to compare that to perhaps the 401k. And we'll talk a little bit about more of that in the next section, but is it different, and is it different on purpose? Is it the same? Is it the same on purpose? And do you have a strategy or an answer as to why? Right? These ideas of investment options are going to become critical as people start to realize the long-term implications of investing within an HSA. Number 3, a registered investment advisor, and this could really be any investment professional, but the question that we're looking to answer here is there some designated RIA or registered investment advisor or investment professional responsible for selecting the investments that are available to the account holders? What's their investment acumen? What is their investment philosophy or thesis? Is it similar to yours as a consultant or an employer? We often argue that employers should be looking at the investment policy statement that was constructed for their 401k, and how different is the investment lineup available to them in the HSA? And again, beg the question, should those be the same? Should those be different? Should different investment vehicles be available? Should we be looking at risk-based investment options? Should we be looking at things like target dates? And we'll talk a little bit about risk in a minute, but all these questions can be viewed through the lens of short-term consumption for healthcare expenses today, or through the lens of long-term investment savings and compounding. And that's something that, again, investment professionals should be able to help you with going forward, and what we think will be a burgeoning opportunity or aspect of their value proposition going forward. Next is self-directed brokerage. Here's a very interesting one where some HSA providers might offer a list of 20 funds. Some HSA providers may offer no investments, and still other HSA providers might offer what we would call a self-directed brokerage option, essentially a window to almost any investment choice out there, right? 5,000 different mutual funds. We talk about the implications of self-directed brokerage in the 401k side, and is that appropriate? And we can ask that same question on the HSA side. Should an HSA account holder have access to every mutual fund under the sun, or should they have access to a list of funds that have been vetted that maybe more closely match the investment acumen of the employee or just the overall makeup of the employee base? We think those are extremely important questions that need to be answered. And then finally, investment threshold. And this is really a proxy for a conversation around risk. And this is something that we hear often. Should investments within the HSA be more or less risk averse than, say, an investment in a 401k? And we think this is where the investment threshold conversation really becomes important. And for those of you who might not be familiar with what an investment threshold is, very simply, it's an amount of money that must be held in cash in the HSA before the account holder is able to invest. Now, some HSA providers might offer a zero investment threshold, meaning day one, dollar one, those assets can be invested in any investment selection or choice the employee would like. Yet other HSA providers would put in an investment threshold of $1,000 or $2,000 or $3,000. And the thought is that investment threshold, or quote-unquote cash cushion for a lack of a better term, can really help to mitigate risk. And you could all probably picture a scenario where somebody goes into an HSA and they put their money directly into the market. They unfortunately, break a leg on the same day of a market correction, and they need to liquidate some of their HSA assets. Well, the idea of the investment threshold is that they'd be able to just take cash from the account before liquidating any long-term investments. And that kind of cash cushion is, I wouldn't call it an implied risk buffer, but you could see how by having cash on the side, you would mitigate that short-term risk of the ups and downs and fluctuations of the market. So, these five: systematic investment capability, investment options, and really reasonable choice. Who's looking at the funds, right? Is it a registered investment advisor or other investment professional? And how similar are those funds to the employer investment philosophy? Is self-directed brokerage appropriate for the employee base? And does an investment threshold make sense? These are all questions that more and more, we'll call them financial advisors, benefit brokers, consultants, are starting to ask, and we think that's a huge step forward as it relates to making the HSA more enticing as a long-term investment vehicle. Now, as we move on to the next slide, here we're looking at, well, why does it matter? Right? Why should I think about investing for the long term? And what this slide aims to show is how by using HSA dollars in a triple tax-free fashion, as Kevin had mentioned earlier, what might that yield you from a real purchasing power standpoint? And what we've looked at here on this slide is how does a taxable account compare to, say, a 401k with a pre-tax contribution, a 401k with an after-tax contribution, or that health savings account, right, with a family contribution that, again, is triple tax-free. And what this study showed us was that an HSA has the potential to give 33% more purchasing power after tax, and potentially 44% more purchasing power than a taxable account. So, again, this speaks to the idea that for the things I'm really going to be spending my money on in retirement, i.e. copays, premiums, deductibles, etc., dollars growing and compounding inside an HSA can go a long way to helping to mitigate those costs and expenses. So with all that said, this isn't a polling question, more food for thought for you all on the phone. Given all the attributes that Kevin had mentioned earlier, the idea that it's triple tax-free with no RMDs and that after 65 the penalty goes away, we've made it a habit of asking groups of people, if you could have, all things being equal, if you could have $500,000 in an HSA or $500,000 in a 401k at age 65, again, where the penalty has gone away, which would you choose? And what we're finding is that, not everybody chooses the same thing, but it definitely gives pause to this idea that, wow, $500,000 in an account that I've grown over a long period of time, that comes out tax-free for health care and at ordinary income tax for everything else in retirement with no RMDs and the ability to pay for long-term care premiums and a host of other great positive attributes. We're not asking you to answer this live, but we are asking you to think about it. And how does that impact maybe the longer-term prospects of your clients and your employees? And finally, with this slide, again, food for thought. what we thought was so interesting about this slide was that when you look at the direction of these numbers, what we're comparing here is we'll call it the presence of defined benefit plans, defined contribution plans, and this burgeoning HSA plan. How do they compare over the long term, right? So this gives us perspective over the long term. And what you see is that, from 1979 to 2010, defined benefits saw a pretty steep drop in the number of employees covered, from 62% of employees in 1979, all the way down to roughly 7% of employees in 2010. Similar numbers, but going in the other direction, 1979 to 2010, as far as it relates to a defined contribution plan, or what some of you might be more familiar with, a 401k or a 403b plan. Back in 1979, roughly 16% of the population had some similar, or 16% of the working employees had a similar option to a DC plan. In 2010, that number was up to almost 69%, and that's a great number, again, to help folks surmount this huge retirement savings gap. But the third number we're looking at here is HSA plans. And when you look at where we were in 2005 at roughly 0%, and we go forward to 2017 at 27%, and then we start to feather in some of the estimates that we've seen going forward, you see how that number and that line grow in a pretty dramatic and rapid fashion. It's estimated that by 2020, 43% of the working population will have some HSA-eligible plan. And from a long-term perspective, we see this growth, and you can't help but think about, where did similar products come from over time? Often we think about the 401k and where that was in the early to mid 80s. Who would have thought it would grow to be a $1 trillion industry? And now we see some great growth in the HSA world as well. And that long-term perspective, I think, also gives us all on this call food for thought. So with that, I'll round off my formal comments and turn it back over to you, Kevin.
Thanks a lot, Ryan. Really appreciate that. And that last slide, it's interesting just to see that similar growth trajectory of the DC retirement plans in that time frame, and overlaying HSAs. It essentially validates what we've already, those of us that are actively in the HSA space, really have felt. So thank you for sharing that. The last thing I'll do to kind of summarize where we started from is, let's first remind ourselves of the objectives that we laid out that we wanted to achieve at the start of our conversation, which was simply to, raise awareness of the retirement plan, the savings gap as it relates to healthcare, discuss those strategies you can use to help for that long-term savings of healthcare expenses in retirement, and then finally explore various approaches using HSAs to create a positive retirement outcome. So hopefully you found that we've done that. The last thought I'll leave you with is really some takeaways that hopefully you will take from this presentation. And the takeaways are very similar yet slightly different for the different audiences. If you're a benefit consultant or advisor, ultimately what I'm advocating for you to do is really to discuss the long-term strategies with your employer clients. And again, as you talk through those ideas, hopefully help facilitate to bring those ideas to fruition. And again, the key component of this is long-term, trying to get out of the norms of thinking of employee benefits and especially medical benefits as an annual election or an annual event, to really thinking for the long term. And that's exactly what we're advocating to do. If you're a plan sponsor employer, ultimately all we're saying is, don't forget about HSAs as it relates to the larger picture of retirement needs. We're not saying that it's the only thing in the picture, but it's a very important tool that can be utilized to help resolve and provide that positive outcome that we were talking about. Again, as I just mentioned, focusing on that long-term view rather than annual election, and encouraging employees at the same time to think and act for both the near and long term. To do that, you really have to stop, evaluate where your employee population is in their life stages as well as their HSA life cycle, and then use the tools and resources available to help engage and educate your employee population as you move forward. So hopefully you see those same takeaways as an important part of this presentation. So with that ends the formal component of our presentation. I'm going to turn it back over to Lynn to lead us through some Q&A.
Great, Kevin. Thanks so much. We do have a number of questions, so let's get right at it. The first one has to do with the amount of money a 65-year-old couple will need to cover health care expenses in retirement. Is that $404,250 representing out-of-pocket spending or medical cost charges before insurance covers some of the cost?
Sure, and I can take that one. This is Ryan Tiernan again. That was total out-of-pocket expenses, and again, we talked to the divergence of numbers. Right? Some are quote-unquote as low as $260,000. For a lot of the stats that were used in this presentation, they were coming from a company called HealthView Services, and what they do that is different and I think unique is that they don't just look at an average number. They actually look at geography, they look at comorbidity, they look at a host of other factors that go beyond just what the average couple will spend, and based on the factors that they add in to give a much clearer picture, that's why you see that number go up so much higher than the standard $260,000.
Okay, the next question is, if you don't have access to an HDHP, can you even open up an HSA?
Yeah, so I can take that. This is Kevin. Unfortunately, if you do not have a high deductible health plan that is HSA qualified, you cannot make current contributions to an HSA. So you do need to have a qualified HSA qualified high deductible health plan to put new money into an HSA. However, with that being said, once the money is in, it's theirs and it's yours to keep and utilize forever, regardless whether you still stay on that same high deductible health plan.
Great, thank you. Next question is, you mentioned you can use your HSA toward Medicare premiums. This is before enrollment in Medicare, correct? Once enrolled, you wouldn't qualify for an HSA.
Well, I had just talked about that same point. Again, once the money is in, it's in the HSA and can be utilized for any qualified medical expense. So while your ability, once you enroll in Medicare, your ability to continue to contribute new money to the HSA goes away, your ability to use the HSA dollars as to pay for qualified medical expenses, which does include Medicare premiums as a qualified medical expense, never ceases.
Thanks for elaborating on that. Is there an annual IRA maximum contribution for HSA accounts?
Well, there's a maximum HSA contribution. I think there was an IRA put in there, but yes, there is a IRS set maximum contribution, which is indexed based on what type of coverage you have, and it gets indexed usually by $150 or $100 per year. And if you ever have any questions as to what the current IRS limits are, you can actually go to our website at hsabank.com, and we update that every time the IRS updates it. In addition to that, if you're age 55 and older, you can contribute a catch-up contribution, and that catch-up contribution is simply $1,000 additional over whatever the HSA contribution limit is.
Okay. At what age does the penalty for non-health usage of funds disappear?
I can take that one as well.
Go ahead.
That's, Kevin, that's, I think, a pretty standard one. It's actually at age 65. So once an account holder reaches age 65 and he or she were to take dollars out of that account for non-qualified health care expenses, we'll call it, greens fees, the 20% penalty that's currently in place would not apply, and that would be taxed, that distribution would be taxed at ordinary income.
Hey, Lynn?
Hey, yes?
I just realized I forgot to tell the audience what the current 2017 contribution limits are. I apologize. So the self-only limit for HSA contributions is currently $3,400, and for families it would be $6,750. Again, that is not including the $1,000 catch-up contributions. And again, those numbers get indexed every year. So.
Perfect. Thanks very much. Can you contribute to your HSA after employment ends, and what are the rules on that?
I can take that, Ryan. So again, really the four requirements that you have to meet to continue to contribute money to an HSA are simply that at the time that you are making the contribution, and contribution eligibility is factored on a monthly basis, there's really four requirements. You have to be covered by an HSA qualified high deductible health plan. You cannot be enrolled or covered by another similar plan that provides benefits as the HDHP does that is not qualified or permitted insurance. You cannot be enrolled in Medicare, and you cannot be claimed as a tax dependent on somebody else's taxes. So as long as those 4 components or criteria are true, you can contribute to an HSA. But again, as I said, once the money's in the HSA, there are no requirements as to how you use the funds. The only requirement really becomes at the end of the year when you file your taxes, you report how much money did you take out and were those for qualified medical expenses or not. If they were not for qualified medical expenses, you have to pay income tax on those. And if you are below age 65, there is a tax penalty that's currently 20% for non-qualified medical expenses.
Okay, thank you. This question is, how can I offer HSAs to my small group clients?
Yeah, so I mean, really, in every state and virtually every carrier generally offers a high deductible health plan that is for sale either on a insured basis or self-insured basis. And I would contact whoever the carriers that you do business are. Sometimes it may not be clear from some of the plan design offerings exactly what is an HSA qualified plan and which ones are not. For instance, you even saw this when the first iteration of healthcare.gov started selling individual policies on the Federal Exchange. They weren't clearly identified as being HSA qualified. Well, HHS has done some changes to the website. In fact, now there's functionality on the individual exchange that you can actually identify using a search specifically for HSA qualified plans. So it should be fairly simple in today's environment to identify and purchase a high deductible health plan that's HSA qualified.
Is there any movement in California to allow HSA contributions state tax-free?
Sure, and just for reminding of the audience, there are currently 47 of the states recognize HSA contributions as a income tax deduction and allow the deductibility on a state income tax level. Again, they're always federally income tax deductible. The 3 states that currently do not are California, New Jersey, and Alabama. And there is a proposal, and I apologize, I forget the bill number that is currently in the California legislature, but I'm sure we can identify that and send that out to the audience or those that care. But the California legislature is actually considering a bill right now to allow the tax deductibility of HSA contributions in California. However, as a reminder, they're always federally tax deductible.
Okay, well, that's going to have to be the last word on the subject because we are out of time. Thank you, Kevin and Ryan, for an excellent presentation. Thank you all in the audience for joining us and for your participation. We hope to see you in another Employee Benefit News Employee Benefit Advisor web seminar in the near future. Have a great rest of your day.